Welcome back, you legends. I'm Dr. Cal. Let's get right into today's video. All the indices down. Dow Jones down 1%, NASDAQ 1.14%, S&P 1.16%, and the Russell leading the declines today 1.32%. If we take a look at the different sectors, leading today was healthcare, tech, defensives, and communication services. And leading the declines were basic materials, energy, utilities, and financial. So this is a bit of a weird mix. Usually on a down day, you'd see things like tech and communication services at the bottom, and you'd see things like utilities at the top. So this is a strange mix, and it's reminiscent of a recession trade. And here's why. If you're afraid of recession, what are you going to sell? You're going to sell basic materials, you're going to sell energy, you're going to sell your banks, your financials. You're going to sell the most economically sensitive names, the most cyclical names, like materials, energy, and financials. You're going to buy secular growth and sometimes defensively secular growth names, things like Costco, things like high quality healthcare names like Eli Lilly, and even things like communication services that you cannot really get rid of, even in a recession, things like your mobile carriers. And that's kind of what we saw today, right? We had the biggest declines in the banks, regional and large diversified. We had the biggest declines in retail and autos, so Amazon and Tesla. We had the biggest declines in energy, and then we had some of the smaller declines in secular growth like big tech, Oracle, Nvidia, Microsoft, and secular growth in healthcare, Eli Lilly, and Amgen. Now, this is kind of strange, especially when we look at today's data. Today, we had retail sales up 0.7% month over month, double the expected or the consensus year on year. Here it is, retail sales up 3.2%, more than twice the consensus. So based on the retail sales data that came out today, the consumer appears to be managing to get by. We even saw business inventories at 0%, no change. So they did not increase their inventory from last month, probably because that excess inventory got sold with that surge in retail sales. More importantly, guys, export prices declined by 8%. Import prices declined by 4%, significantly below expectations. The market was expecting both exports and imports to decline, prices for exports and imports to decline a lot more than what they did. So strong retail sales, export prices and import prices not declining far enough. All of these feed into the ideas that inflation is resilient and that the Fed will likely have to hold for longer, bringing about that recession. Remember, the longer the Fed holds these high interest rates, the weaker the economy is going to get and the deeper the recession is going to be on the other side. With that said, let's jump right into the daily chart. Finally, we filled the gap at 442.5. Finally, we got it done. Another major development on the RSI is this. Look at this. Perfect tag of our support, perfect tag of our support, perfect tag of our support. What happened each time this happened? Well, when we tagged it back in March, the market was forming a bottom. When we tagged it back here in September and in October, the market was forming a bottom. And it looks like the market has tagged it again. The key here is that this trend line needs to hold. If it holds tomorrow, if it holds for a couple days, that very likely means that the market has formed a bottom today. Another key development, obviously, is the gap fill. The gap fill is significant because it means that bulls will now very likely have more courage to allocate capital because a lot of money was watching this gap to get filled. Now, finally, we got it filled, and this is a key zone because it was resistance twice, and now it should act as support. It's what we call a pivot zone, a zone that acts as support in the past and then switches to resistance, or vice versa. Resistance in the past and then support right now. What else? Well, we have a close below the 50-day moving average for the first time really since, since April, since March 30th. This was the first close below the 50-day moving average, which likely means that more weakness is likely to come, even if we get counter trend bounces to the upside. And usually, guys, in the second half of August, from the middle of August to the second half, that's usually when we get bounces. and those bounces usually get faded. So that's still our expectations. We're still expecting a bounce that gets faded, and this close below the 50-day moving average is a warning shot that there's something major changing in the trend. This is the first close below the 50 days since that volatility contraction rally, this monster rally that I talked about all the way back here when it was forming in May. Let's take a look at the 1 hour chart. Here it is, perfect gap fill at 442.5. This is the demand box. This is the demand zone of 442.5. A lot of previous trades here, guys, in the past. So I expect a lot of new buying pressure to come in here, especially with these bullish divergences on both the PPO down here and the stochastic up here, both showing bullish divergences, higher lows as the market is making lower lows. That's a classical bullish divergence, common of these descending wedge patterns. We had a break yesterday. We did not get follow through today. That rally ended in the sneaky futures market. The futures market shorted it just before the market opened, just as these numbers came out, reigniting inflation fears. And this time, inflation fears and that these inflationary pressures will lead to the Fed holding for longer, and that will lead to recession. So it's playing 3D chess. You have to follow the string of logic, one idea at a time, and you have to look at the source that's driving all this price action, and things like the different sector performance and the retail data and things like that usually gives you a good idea of what's happening. Okay, so this is the S&P. Falling wedge, we broke it twice. That means bulls are trying to break through. They broke once, they failed, they broke again yesterday and closed above the 5-day moving average. That was a major milestone. They ended up failing. They could not carry it through, probably because this gap was acting as a magnet, right? This was a magnet pulling price down. Now that we've got this unfinished business finally finished, we should start to see some more constructive market structure forming. Again, we're looking at this range. We divide it into two halves. As the market is trying to find a bottom, you'd see things like this, an accumulation in the lower half, then a break above, then an accumulation above the upper half. That's kind of still what we were expecting here, especially with a big news coming out tomorrow. Not the building permits, no, the FOMC minutes, the Fed minutes coming in at 2 p.m. tomorrow. So probably muted price action until 2 p.m., then fireworks. Very likely fireworks at 2 p.m. Everybody is waiting to really figure out whether the Fed is going to raise rates at the next meeting in September. If I look at the Fed watch tool, there's a 90% chance, the market is pricing in a 90% chance of no hike at the next meeting in September. Now, if we get any hints in the Fed minutes that the Fed is actually thinking about raising rates in September, if we get a lot of debate between different FOMC members thinking about raising rates, this percentage is going to get crushed. We'll see this 10% shoot up, and we'll see yields rising, and the S&P likely getting even weaker, likely even more weakness if we get any hint that the Fed is raising rates again in September. Otherwise, technically speaking, gap fill finally done. We have this back test of this key support line on the RSI that lasted months and months and months. We'll see if it holds. We don't know yet, but if it does hold, likely we get a bounce here. But most importantly, there's one chart that I would put 90% of weight over. It's the VIX. The VIX is doing something fascinating. Up top, guys, is the volatility index. Down below here is the S&P 500. Here's what I want to show you. When the VIX moves up, the S&P 500 moves down. It's an inverse correlation. What's the psychology behind it? Well, the VIX measures the premium of options contracts, particularly more weighted towards put options. Put options are basically insurance against prices declining. You would not buy insurance unless you're afraid, unless you're bearish, okay? So that's basically why we see prices decline when the VIX rises, or vice versa. We see the VIX rise when prices decline. That's because of fears. Fears of price declining leads a lot of investors to buying puts to protect portfolios. That leads to put premiums rising and a spike in the VIX. Okay, that's simple enough. That's not the key here. The key is what happens around tops and bottoms. And in this segment, I want to focus on bottoms, okay? What do we see when the market is trying to form a bottom? Here's a bottom, slightly higher low, and significantly lower high on the VIX. Now, if the market was equally bearish at this low, you'd see the VIX rise much higher, okay? So that's what is called a bullish divergence. The VIX is not corroborating the fear in the price action. Another example is this. Here it is. Price makes a lower low, okay? Significant lower low. VIX makes a lower high. That means fear was not as high, okay? Fear did not spike as high. It did not corroborate the fear. It did not corroborate this lower low in the price action. We had a bottom. Another example is here, even in the smaller pullbacks, guys. You see this behavior even in the smaller pullbacks. Let me show you what I'm talking about. Here it is, slightly lower low on the S&P 500, significantly lower high. The VIX, the fear index, did not corroborate this lower low. The market rallied. We had a bottom. Again, in May, lower low on the S&P 500, lower high in the VIX. The VIX did not corroborate this low, did not corroborate the fear. The market rallied. Another example in June of last year, lower low on the S&P 500. The VIX did not make a higher high. It made a lower high. It did not corroborate the fear. The market rallied. Another example in this counter trend rally in September. Equal high on the VIX, even though the S&P made a lower low. The VIX did not corroborate the fear. The market rallied. Another example is the October bottom. This October bottom we called to the day. We called this exact bottom a day before it happened. And in fact, one of our members made the biggest profit I've ever seen out of any trade, 10,000% in a single day. Yeah, 10,000% trading SPX daily options. Absolutely crazy trade. Go back to watch that video. Anyway, lower high on the VIX did not corroborate the lower low. The market bottomed and it rallied. Now, we did not get a lot of these signals recently after the October low. We did get a few. I did not really mark them, but here's another one. Look at this, guys. Lower low on the S&P 500, lower high on the VIX. The VIX did not corroborate the fear. The market rallied. In this example, we had a lower low on the S&P 500. This was after the banking collapses, the Silicon Valley bank collapse. This time, the VIX did not put in a lower high. The VIX did corroborate the fear. The fear was real, but the market ended up making higher lows, and it recovered anyway. Throughout this period, we did not really have any big sell-offs to speak of until the recent sell-off that began a couple of weeks ago. And we're seeing the same exact pattern. Here's what I'm talking about. Let's zoom in. Up top is the VIX. Lower high today as the S&P made a lower low. The VIX did not corroborate the fear. It made a lower high as the S&P made a lower low, potentially meaning that the market is forming a bottom and the VIX will end up corroborating the bullishness and continuing to decline to fill this gap at 14 as the market sees a relief rally coming in fairly soon. Now, guys, the VIX is an amazing indicator to spot tops as well, not just bottoms, but also tops in the market. I had these marked, all of these marked stock market tops. I talked about these at length last year. If you're interested, go and watch last year's videos. I talked about all of these signals marking stock market tops, and we went short at every single one of these tops, every single one. Now, I have to make this very clear. There's absolutely no certainty in the market. Nothing is 100%. We just trade the probabilities and we try to enter at the best possible time to maximize the probability or chance of success of our trade, whether that's a short trade or whether that's a long trade. And an amazing psychological trick that I learned from Warren Buffett is this. Not actually Warren Buffett. It was Charlie Munger. And it was this basic idea of asking yourself the opposite question. For example, you'd ask yourself, would I short here? Would I short the market after this entire move to the downside? Would I short the market here? If the answer is no, then you should not sell. If you're holding long positions in your portfolio, if you would not short this time, you should not sell. The opposite is true. Would I buy the market here? Would I buy it here? The answer is yes, I would buy the market. Then I should not sell. Pretty straightforward. Exact same logic can be applied, for example, on this bearish engulfing candle. Would I buy the market? Would I go long at this candle? If the answer is no, then I should sell. I should take profit. I should liquidate some of my long positions. We had also discussed this island reversal pattern. It was identical to this island reversal pattern. We expected a gap down and a sell-off. We got it. I could not get a video out as this pattern was forming, but I did put a note out in the trading community. And I warned everybody that this looked creepy. That's the word I use. This is very creepy. And we ended up gapping down and selling on the credit downgrade of the US Treasury. And we've been moving down since. We have a key event tomorrow. Again, that FOMC FOMC minutes release at 2 p.m. Eastern time. And let's take a very quick look at what the smart money is doing. Same thing, the smart money still forming a bullish divergence. We had a few of these examples. Here's a clear bullish divergence back in April when the market was topping. We had the high yield bonds making a higher low as the S&P made a lower low, and we ended up with a 2-day relief rally. Here's another example, guys. As the market was selling off, this sell-off is actually very similar to what we're seeing now in terms of magnitude and length. And we had a higher low on the smart money. That was a bullish divergence as the market was making a lower low. We ended up with a 3-day relief rally. Very likely, guys, that relief rally, when it comes, will be used to sell. Very likely that relief rally will stop at the 20-day moving average, potentially slightly higher at 452, slightly lower than 452, maybe 451.6, something like that, around this area. Very likely, whatever rally we get will fail at this point, and we should continue to go down. Let's take a look at market seasonality. Usually, guys, in August, we get a sell-off at the beginning of August, then a bottom around the middle of August, and a bounce back until the end of August, a relief rally, then another sell-off in September, and another one in October in all pre-election years. Take a look at just August. Again, a bit of a bottom in mid-August, a counter trend move, a rally towards the middle of August, another dip, another rally, one final sell-off by the 20th, and from the 20th on, we should see a robust multi-day rally. We're somewhere in the middle here, so a bit of a choppy period, lots of ups and downs. We haven't really seen any big up moves other than yesterday and that rally that got faded on the 10th of August. Not much else. Not much else. It's extremely rare for any sell-off to last without any relief rallies. Usually we get at least two relief rallies after any stock market top. The first usually stops at the 9-day moving average, the second one at the 20-day. The first one usually at the 9-day. This one overshot to the upside. We did not get another relief rally. We had a major bottom here, and another one is right here. First one to the 9-day, the second one to the 20-day. You'll see lots of these examples. Here it is. First one to the 9-day. Overshot it a little bit. The second one roughly to the 20-day, missed it by just a few points. Another one here, first one to the 9-day, the second one to the 20-day. So if we count this as the first relief rally to the 9-day that failed, we should get another one to the 20-day that also fails. Let's take a quick look at XLY, consumer discretionary divided by XLP. We're actually forming a bull pennant. This is a bull pennant. A bull pennant is basically a bull flag with a triangle at the top. That's what we're seeing now. We haven't broken to either direction. Usually bull pennants break to the upside. They can sometimes break to the downside. We haven't seen a decision made just yet. We're just seeing price tightening. The XLY divided by XLP had a second close above the 20-day moving average today. The first close was yesterday. The second close was today. And if we take a look at the NASDAQ, let's take a look at the daily chart. The NASDAQ actually made a higher low today as the S&P made a lower low. That's a bullish divergence. When you see the NASDAQ beginning to lead, that's usually when the market finds a bottom and begins to tick upwards. That's usually what happens. We had a higher low today on the NASDAQ. But overall, the chart does not look overly bullish just yet. It does look negative still, PPO is still pointing down, about to cross the zero line. The histogram is still red. And this still looks negative overall, still looks negative. We need to see the PPO flatten. We need to see the histogram flatten and beginning to rise for a more sustainable rally. Otherwise, any really quick spikes to the upside will be shorted very likely, and we will continue to the downside until and unless the PPO flattens and begins to rise. Exact same look here, guys. The NASDAQ summation index still negatives. The oscillator very deep in the red. We usually, when it gets this deep in the red, we get some relief rallies. Not always, but usually that's what tends to happen. That rally gets sold, makes a lower high. We continue lower, and then we get a longer term or a medium term bottom. Same look here, guys, on the summation index for the NYSE, still negative. Stochastic still deep, the oscillator still deep in the red. So overall, the trend is still down. Rallies to the upside will be shorted. They will be short-lived. They can be vicious. They can be extremely violent, but very likely they will fail, okay? Very likely they will fail. Usually what happens, we get something that looks like this: double bottom, lower low on the second low, higher low on the PPO, and we get a divergence that usually ends up being the bottom, and we rally to the upside. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.